Right, let's move on and get on board our guest for today to help us understand the construct of the market and the way forward and how should you be looking at your investments. We're joined by Nilesh Shetty, who's a portfolio manager, Quantum Advisors, now joining us. Hi Nilesh, good afternoon to you. Thank you so much for joining us today. Nilesh, tell us, the volatility is back in the market and this is no doubt a stock pickers market. Tell us what are the pockets of value that you see amid this volatility and now when the markets, when the dust settles and the markets start moving up, what are the sectors that could lead from the front?
You have to remember India started correcting in September of last year. And the primary construct then was that there has been a significant disconnect between valuations and earnings growth. And that has not materially changed. Even in the March quarter results, earnings growth was cumulatively for the BSE 500 was in low single digits. So the rally after that, especially after the ceasefire, where at least in the last month the small cap index rose 10%, has been very surprising, which again sort of has created that disconnect between valuations and underlying earnings. So we remain very fairly cautious. There are pockets of opportunity, and for the largest pocket remains private sector banks. They trade substantially below their long-term valuations. The other big opportunity remains insurance, as well as IT services. IT services is, again, it's not a near-term story. It may be perhaps a 2-year, 3-year story where you may have to wait for the discretionary spend in the US to pick up, and valuations remain comfortable. So our largest allocation in the value portfolio currently remains banking, IT services, consumer discretionary, and within financial services, we also have a large allocation to insurance space.
All right, so that's the take coming in on the markets. Good afternoon, Nilesh. Cheryl also joining in the conversation. I just wanted to check what's your, which side of the fence are you when you talk about your investment in particular sectors? Which sectors are you liking right now? Is it going to be all-time favorite, that is banks where everyone's been betting on?
Yeah, that's the obvious place where valuations look very comfortable. That is where our largest allocation is. But unlike the market, we also prefer IT services right now. We think there is significant opportunity if you're a patient investor there. And we've been slightly ahead of the curve in the insurance space where we bought it when there was significant disconnect between valuations and where we think long-term fundamentals for the sector is. We are slightly away from the market on certain sectors. Like we don't believe consumer staples still offer value. We have zero allocation there. And we still don't believe capital goods offer value. The valuations in capital goods sector now rival consumer staples or even higher in most cases, which I think, again, given the cyclicality of the sector, I don't think those valuations will sustain and investors may see a negative surprise there.
Please talk to us about SMIDs because that's a very tricky space to navigate. Despite the correction that we saw, people were talking about that the SMIDs is still, the valuations are still premium despite the correction. Now, again, the SMIDs are definitely outperforming the benchmark indices. How does one look at that space? Because that's where you generate the alpha, right? I mean, anyone who wants to generate wealth would want to be in small and mid caps.
Yeah, the small and mid-cap space are extremely overextended in valuations. From the sort of peak in September, they had corrected by about 25-30%, while individual portfolios perhaps could have seen a larger correction, but they've rebounded quite strongly. And now at the end of May, they are within 10% of their all-time high. So that disconnect between valuation and earnings has not disappeared. Investors need to understand that extra return that they think they will get also comes at the cost of poor governance and poor liquidity, which the small and mid caps are meant to compensate an investor for. And in a lot of the cases, they don't. Unfortunately, the governance risk and the liquidity risk is fairly high, especially for a large institutional investor like us. So we actually have very low allocation there. Selectively, we might find some opportunity at a stock specific level. But at a cohort level, we think valuations remain far above their above comfort level for investors.
Right. Hi, Nilesh. Good afternoon. This is Shrishti. Give us some sense that sectorally, where do you find the margin of safety in this kind of an environment? Like you have been highlighting that the valuations, especially in the SMIDs, are not offering that level of comfort. But any area or any pocket where you believe that the valuations are reasonable and with respect to the recent earnings as well, any pocket that you believe is something that you should be watching out for maybe for the next couple of quarters?
Yeah, in the large caps, it's primarily private sector banks that we have a large allocation to. In the small and mid caps, I mean, we had selective names in say health insurance where we added to the portfolio. Earlier, we were able to find an asset management company which we were able to add to a portfolio. But apart from that, it's still private sector banks, IT services, two-wheelers, primarily, and insurance companies where we think there is comfort in valuations. Automobiles less so as they've rallied last year. We've reduced our weight, but still continue to hold some of them in the portfolio.
But Nilesh, like you just highlighted, life insurance is something that you have added. Help us understand what's really changing for the life insurance companies, and specifically, how is the sector, do you believe, will perform very well? Because of late, the numbers have been moving okay. They have been moving higher in terms of their APE and the VNB growth numbers. But as a whole, the industry is still not showing those high double-digit growth numbers.
Yeah, I mean, we added life insurance about a year ago, where because of intense competition within the space, commissions had risen, because of which VNB margins had come down, and regulatory changes on the kind of product that you could, or taxation on certain products, including non-par, that sort of led to a sell-off in the category. But when we added, they were just trading at slightly above one-time embedded value, where we thought, even factoring for the slightly lower growth rates and the margin of safety in margins, we thought valuations look very, very comfortable. Since then, they've moved ahead. They have recovered, and some of the private sector names which are growing quite slowly have now sort of come back to sort of early teens kind of growth. But at those valuations, we still think there is comfort given the structural story that is there in the life insurance space.
Also talk to us about the IT services, because you have your largest allocation in the IT services also. What is making you so bullish? Is it the valuation comfort post the correction, because the macro headwinds might still persist for IT, right? So what is giving you comfort in the IT space?
So the valuation is the biggest driver for us when we select stocks. We understand that next few quarters could be tough in the space, given the uncertainty in the US, which remains the largest client base for most of the large IT services companies in India. But eventually, that discretionary spend has to pick up. I mean, you just have to go to large corporations in India, so in India and overseas, to see the legacy IT systems that they're running on. And there is not many, at least globally, not many players who can upgrade those systems barring Indian IT services companies. So our sense is at some point IT services spend has to pick up. It's a very simple story where the cost of an engineer in India is far lower than what you have in the West. And if a large corporate wants to upgrade the IT systems, Indian IT services companies will be the top three in their sort of selection criteria when they do give contracts out. So we would rather buy these companies when valuations are comfortable for you and not wait for the rebound in IT spending.
All right, but Nilesh, before we sum it up, if we can have your comments coming in from where do you see the markets headed? If somebody has to make a strategy right now, what should that be? Remain very, very stock selective, because you just highlighted a couple of sectors for us. But broadly, if you can give us some sense that as a strategy, how can viewers place their bets, what to expect from the benchmark indices, and any sectors which offer a fresh buying opportunity?
Yeah, I mean, for investors, I would say avoid small and mid cap space. I think there is still significant fraud there. The large caps are okay. I mean, the index itself is trading at slightly above long-term averages. So you have opportunities in the large caps. I just think investors have to temper their expectations. The returns that have come over the last 3 years is not going to repeat over the next 3 years. I think returns will be far lower than what they've seen in the last few years. Probably in the low teens or even high single-digit returns for investors. So investors have to calibrate their allocation and perhaps tilt it more towards large caps.
All right, Nilesh, thank you so much for taking the time out and joining us today and weighing in on the markets. We will let you go on that note. Thank you so much for tuning in then.
If you like this video, then like, share and subscribe to ET Now.